Inside a Taichung memory fab last quarter, every 300mm wafer rolling off the line was already sold. 3 quarters forward, Apple hadn't even spoken yet. What you're about to see is the signal Apple accidentally leaked when it raised iPhone storage pricing. The two tickers already absorbing it, and the repricing Wall Street analysts are now calling inning 2, not inning 8. Quick gut check before we go deeper. If you had to pick one stock right now, the company making the memory chips or the company storing what those chips produce, which one gets your capital? Picture a clean room at Micron's Taichung fab. Operators in white suits, mask aligners running 24 hours a day, robotic arms pulling 300mm wafers off the line. Now picture this. Every single one of those wafers, before it ships, already has a buyer, not just orders coming in. Booked through 2026. That is the situation memory leaders Micron and SK Hynix described to investors on their last earnings calls. HBM allocation for calendar 2025, gone. The 2026 allocation conversation is happening right now between supplier sales teams and hyperscaler procurement desks. When supply is gone before it's made, prices only move one way. That changes how memory stocks should be priced. If you are holding Micron or thinking about it, stop comparing the chart to the last commodity cycle. Compare it to a backlog-driven industrial. Set your next price check to coincide with the next earnings call, not the next NAND spot quote. Before we get into the names, do me a quick favor. If you want in-depth market analysis that goes beyond the headlines, subscribe to Stock Pulse Alpha and turn on notifications. Every week, we break down high-conviction investment opportunities, market trends, and long-term strategies designed to help you build wealth with confidence. Join the Stock Pulse Alpha community. It only takes a second, and it helps this content reach more serious investors like you. Here's what almost every viewer missed when the Apple pricing story hit. The headline said iPhone storage tiers cost more. The real story is buried in DRAM and NAND contract pricing. Apple negotiates multi-quarter supply contracts and typically absorbs short-term price moves on its own balance sheet. When Apple chooses to pass costs through to the consumer, that says contract pricing did not spike for a month. It re-rated. TrendForce reported DRAM contract prices rising roughly 15 to 20% across recent quarters, and NAND followed the same trajectory. Apple does not pass through noise, only structural shifts. For investors, that is a tell. Stop watching Apple's gross margin guide as your signal. Pull up Micron's contract pricing slide from the next quarterly deck. That is the page telling you whether the 2026 setup is still intact. Bookmark it before the next earnings date. Here is the claim, plainly. High bandwidth memory, what the industry calls HBM, is no longer part of the commodity DRAM market. It is a separate product, with separate buyers, separate margins, and separate pricing dynamics. Micron's HBM3E ships into NVIDIA's H200 and Blackwell systems. Each accelerator pairs with multiple HBM stacks, and the bill of materials for memory inside a single AI server now rivals the cost of the GPU it surrounds. Micron has publicly guided HBM as a multi-billion-dollar revenue line for fiscal 2025, at gross margins above the company average. HBM is not DRAM anymore. It is a new category. For investors, that reframes the entire thesis. Treat the legacy DRAM line as the floor of the business, not the ceiling. Build your model with HBM as a separate revenue stream, growing on its own curve with its own pricing power through at least 2027. Compare the old Micron to the new one. The old Micron was a textbook commodity cyclical. Price-to-earnings multiples collapsed at the peaks because the market assumed peak earnings could not last. Investors bought low, sold high, and refused to pay a premium for forward earnings. The new Micron looks different on every line that matters. Margins are expanding because HBM mix is climbing. Earnings revisions from sell-side analysts have moved up across the past several quarters, not down. The customer base is now anchored to hyperscalers committing CapEx multi-year, not consumer PC refresh cycles measured in months. Same ticker, different business model. That distinction matters more than any chart. Before you anchor to the price-to-earnings multiple Micron deserved 5 years ago, look at the customer concentration in the most recent 10Q. If hyperscalers dominate the order book, your multiple needs to update too. Take Sanjay Mehrotra. Micron's CEO has now stated on multiple earnings calls that the company's HBM capacity is sold out for calendar 2024, and that the overwhelming majority of 2025 supply is already allocated to customers. He has begun describing the 2026 allocation conversation as actively underway with hyperscale buyers. That kind of forward allocation language does not come from a commodity supplier, it comes from a constrained industrial. Behind it sits Micron's Boise expansion, the New York fab announced under the CHIPS Act, and the Hiroshima ramp in Japan. Capacity is coming, but the lead times are measured in years, not quarters. Demand is here now, supply lands in 2027. For your portfolio, the takeaway is operational. Track Micron's quarterly CapEx disclosure and the timing of the New York fab milestones. Those are the gating items on whether the multi-year supply story actually holds together. Quick pause. If this breakdown is landing, hit subscribe so the next one finds you the day it drops. We have a third ticker queued up for next week, the equipment supplier sitting behind both Micron and Seagate, and the angle most retail coverage will completely miss. What does Seagate ship that Micron physically cannot replace? Storage, not memory. A hyperscale AI data center needs both, and they are not substitutes for each other. DRAM and HBM hold what the processor is working on right now. Drives hold everything else. The training corpora, the model checkpoints, the historical logs, the petabyte-scale data lakes feeding the next training run. Seagate makes the high-capacity hard drives that fill those racks. Their newest platform, Mosaic 3 Plus, uses heat-assisted magnetic recording, called HAMR, to push drive capacity past 30 terabytes per unit. Memory runs the model, storage feeds it. For investors building a paired position, that distinction is the entire point. Look at where each company sits in a hyperscaler's bill of materials. Micron and Seagate are not competing for the same dollar, they are stacking. Both grow as the data center spend scales. Walk into a hyperscaler colocation row at one of Meta's or Microsoft's data centers. Picture a single rack, 36 high-capacity drives, each holding 30 terabytes. That is roughly 1 petabyte of storage in one cabinet, drawing a fraction of the power of the GPU racks 2 aisles over. Now multiply that by the number of racks going in during a single CapEx cycle. The 4 largest hyperscalers, Microsoft, Meta, Alphabet, and Amazon, have collectively guided CapEx above $300 billion for 2025 in their last quarterly earnings releases. A meaningful share of that flows into storage infrastructure that Seagate and Western Digital dominate. Petabyte racks scale with CapEx, not with consumer demand. For positioning, ignore the consumer drive cycle entirely. Track hyperscaler CapEx commentary in the next earnings season. The 4 numbers you need fit in a single screenshot, and they tell you Seagate's demand floor for the next 12 months. Here is a number most retail investors have never sat with. The combined 2025 CapEx of Microsoft, Meta, Alphabet, and Amazon is on track to exceed $300 billion. That figure rivals the entire annual R&D spending of the S&P 500 a decade ago. That is what the AI build-out looks like at the balance sheet level. It is not a story about chatbots. It is a story about 4 corporate balance sheets reallocating capital at industrial scale into compute, into power, into memory, into storage. The companies sitting in the middle of that flow do not need to win every customer, they need to keep shipping. 4 buyers, 1 historic check. That changes how you size positions. When the demand driver is 4 named buyers committing multi-year, the question is no longer whether the spend continues, it is whether you own enough of the suppliers feeding it. Honest contrast time, because every other channel skipped this part. The bull case is real, the risks are also real, and you need to hold both at once. Risk 1, Changshin Memory Technologies, the Chinese DRAM maker known as CXMT, is ramping capacity that could pressure commodity DRAM pricing into 2026. Risk 2, hyperscalers can pull orders forward, meaning a stretch of strong quarters could borrow from the next year, leading to a single weak guide that rattles the stock. Risk 3, the memory cycle has not been repealed by AI, only deferred and reshaped. Structural demand does not erase cyclicality. Counter each risk before you act. CXMT cannot produce HBM at scale yet, pull-ins eventually normalize. The cycle question becomes the holding period question. If you cannot hold through a single rough quarter, your position size is too large. Right size first, conviction second. The claim, stated cleanly, the repricing of Micron and Seagate is in inning 2 of 9, not inning 8. 3 reasons sit underneath it. First, HBM revenue at Micron is set to scale through fiscal 2027 against a fixed near-term supply ceiling, meaning gross margin can keep climbing before new fabs catch up. Second, Seagate's HAMR transition is still rolling out across the installed base, and each generation reduces cost per terabyte while expanding per drive capacity, a structural margin tailwind through at least 2026. Third, hyperscaler CapEx commentary for 2026 is already being framed by management teams as higher than 2025. 3 legs, all pointing forward. That is the forward-looking window. Calendar 2025 through 2027 is the runway where the thesis either confirms or breaks. Mark those quarters in your calendar. Review position size against each earnings print. Adjust on data, not on price action. Apple's price hike was not the story, it was the signal that DRAM contract prices and HBM allocation crossed a structural threshold. Micron sits at the active compute layer. Seagate sits at the archive layer. Both are paid by the same 4 hyperscale balance sheets committing CapEx multi. Next week, the third name in this chain, the equipment supplier behind both, and why it might be the highest margin position of the 3. Not professional advice, consult a qualified expert as needed. Before you go, before you leave, do 3 quick things for me. First, hit that like button if this analysis gave you something to think about. It genuinely helps Stock Pulse Alpha reach more investors who are serious about building long-term wealth. Second, subscribe to Stock Pulse Alpha and ring the bell if you haven't already. We publish in-depth market breakdowns, stock analysis, and high-conviction investment ideas every week, and you won't want to miss what's coming next. Third, leave a comment telling me and let me know which sector you'd like us to cover next. I'm working on a deep dive into an opportunity that most investors are completely overlooking in the industrial automation space, and that video is coming very soon. Until then, stay curious, stay disciplined, and remember, price is what you pay, value is what you get. Thanks for watching Stock Pulse Alpha. I'll see you in the next one.